Hey guys, today is December 13th, 2018, and in this video, I'm going to share a few secrets that I believe will be helpful to those of you who are day traders or swing traders. So the biggest secret to trading to me is this: trade big when odds are highly in your favor, and trade small or don't trade at all when the probability is low. So it's all about math and probabilities, not the news as generally believed. And here's what I mean by that. A lot of times, I get people that try to reach out to me and they say, well, I'm a day trader. I want to make $100 a day. I want to make $500 a day. I want to make $1,000, $10,000 a day. And all those goals are great. There's nothing wrong with that. However, there is one common flaw with such ideology, and that is the very fact that the market does not present you with an equal opportunity each day. And therefore, given the fact that you're utilizing the same strategy, you're not going to be able to match the same earnings each and every day. And I'm a big believer in the fact when the market is giving you an opportunity to make 10,000, 20,000, and you're walking away from your trading station by 10 o'clock because your goal for the day was 200, I think you're highly underperforming. Now, on those days when the market is giving you an opportunity to make 200, but you're making 400, well, you're definitely outperforming. So the idea, however, is to avoid trading on days when the probability is low. And so most of the time, I spend my time studying the charts, studying the divergences. But over the years, I've developed a formula that I call the 13 markets move formula that helped me identify the next market move. And in order to do that, I'm going to show you some examples. Now, clearly, nothing is going to be able to help you identify everything with 100% probability. The idea is simple here, guys. You want to not trade or trade with very small positions. So in other words, if your typical position is 20 contracts, then on the days where your probability is low, trade with 2 or 3 contracts. If your average position size is 10 contracts, then trade just 1 contract. If your average position is 100 contracts, then in those low probability days, maybe just trade 10. Literally like 1/10 of what you typically would do. So in that case, it's going to help you outperform the markets long term. Oftentimes, I find situations where traders blow their accounts up simply because of the fact they've been making money. All of a sudden, the market environment changes a little bit, and instead of diminishing their position size, they keep utilizing the same strategy in a very aggressive way. Oftentimes, instead of decreasing their positions, I find out that traders actually increase their positions. And at that particular moment, it's actually the highest point of risk to be increasing your position. So hopefully, I'm going to share a couple of things here with you that's going to help you, if not identify, but at least keep this on the back of your mind, that being a day trader does not equate that you trade every day. Being a day trader means that you're observing the markets, that you're doing your homework every day. And so if you're not sure what the homework is, I promise you, you will be a much better trader if you study the chart and look at 30 to 50 charts every day, opposed to listening to, say, CNBC News for an hour or 2 hours a day. That's going to be a much more effective strategy. Now, if you learn how to identify the market moves, I've put a ton of detail into the course. It's a 13 markets move course. It's 5 hours detailing all the market moves. But first, you're probably wondering, what are the market moves? So in this video, I will share with you a market move sequence that has helped actually a lot of our traders make a ton of money in October. Literally had some guys start with 20, 30K that ended up making for the month of October, north of 200,000, 300,000. Actually had one person hit over 500K. Now, sequences had much lower probability in November, and as a result, trading with large positions was a total disaster to about 5% of our traders. I'm making this video with an end in mind that you're going to be able to understand the main concept of when to trade small and when to trade heavy. And what I'm currently observing should be very helpful, because what I'm observing is a market move sequence that highly resembles a very important sequence that we observed that had helped a lot of guys made a bunch of money. And so the question is, how can you utilize it? All right, first, let's take a look at this. This right here, just pretend that this is on a chart, right? This is an example of one of the market moves. There's 13 of them. But what do you see here? The key idea here is that the market is overall positive. It looks like things are going higher and higher throughout the day. And then in the latter part of the day, let's say between 2 and 4, oftentimes, especially between like 3 and 4, 3:30, 3:45, all of a sudden you got like a sharp sell-off. That is a characteristic of a move 6. Now, another move that is similar in its characteristic would be like a move 11, where things, they may start just a few points under, a few points over in the morning. Then it's going to draw sort of like a pyramid. Okay, and the pyramid can take at any part of the day, but it's going to resemble a pyramid. At some point, you're going to be able to clearly identify the market tries to go higher, but it struggles, and then it sells off again. It literally gives up all the gains that were created intraday just to end up roughly within a few points from where it started. So just keep that in mind as we're going through this, okay? So move 6, move 11, what is the main characteristics that they share? They are market top type moves. In other words, they point out to the fact that the market is losing traction. The market is having a hard time moving higher. So that's the characteristic that they share. Think about maybe you live in San Francisco, some other area that's got a lot of hills. When you park your car, okay, let's say you're driving a stick and you're on the steep hill. What's going to happen? Well, the car is going to roll back, right? Unless maybe you put an emergency brake on, right? So just think of these moves just like that. You're going uphill, and then you're all of a sudden you drop off because you forgot to put the emergency brake on. And so this is what happens right here in these market top move formations. Now there's some other ones. Now my goal is not to disclose every 13 markets move. If you want to do that, you can study the chart course and the 13 markets move course. What I am going to say is this: the idea, the concept, right? There's 13 variations of these moves. Basically, it's like chess. The market can take 13 different moves targeted at you as a trader. Now, the answer to high probability outcomes lies in the understanding of a market move sequence. Now, you're going to be able to observe a sequence over 2 days, 3 days, 4 days, 5 days. And the idea is this: some of these market move sequences will indicate with a high probability of what will happen the next day. For example, a sequence 4-13-1 will indicate that after a sequence of 4-13, there is a 90% probability the next day the market is actually going to open higher and proceed higher for the rest of the day. Now, can you imagine if you knew before that actually happened the day before? What kind of action would you be taking? Well, clearly you'd be buying a bunch of call options, right? And because your probability is at 90%, you wouldn't just be buying one. If your typical size is 20, I mean, on that day, you'd probably be buying, 30 or 40 contracts. If your general position is, 2 contracts, on that day, you would probably be loading up buying 4 or 5. Okay, so now on some days, the sequence could be neutral and point to a low probability. For example, sequences that there could be some days like 7-8-1-7. That sequence has no probability of predicting specifically what is going to be the next market move the next day. And so sometimes, in other words, you're going to have some sequences that are going to be very highly predictive of what's going to be taking place the next day. And in some instances, there's going to be basically a very low probability. And in those days, you want to stay away from putting on big positions. It's okay if you trade a specific individual stock. Like an exception would be, think of a biopharmaceutical stock that announces like an FDA approval. It doesn't matter whether the market is going lower, higher that day. If it's a favorable FDA decision, that biopharmaceutical stock is going to go through the roof no matter what, right? So in that case, it makes sense to trade options on that particular stock. Now, where this concept becomes incredibly helpful is when we begin to start trading options. Because, number one thing with options, it allows you to trade higher price stock and really participate with the big gains and the big guys, meaning the institutional investors, help you participate in high price stock that trade above 100 to 300,000 bucks. And that's where trading options gets exceptionally lucrative. A lot of times, I have people reach out to me and ask me questions. And one of the first few things we typically identify within the first 10 minutes is that they're trading options on the wrong stocks. And oftentimes that happens, for example, with a person that's been trading a lot of lower price stocks like penny stocks, $2, $3, $4, $5 stocks. And so they're still trying to find stocks and trade options on these cheapest stocks. Well, the main idea of trading options is that you will get a lot of traction and significant returns by trading options on these higher price stocks, because it's just a simple mathematical equation, right? 3% of $10 is 30 cents. 3% of the $1,000 is $30. So it makes a lot more sense, especially you're dealing with options, to reap off the rewards by trading higher price stocks. So this formula, the 13 markets move formula, is going to be especially handy because it really tracks the movements in the S&P 500 and NASDAQ, for example. It can also be applied to some high performance like Amazon and Google and so on. And so you really grasp how to use that. You're going to be able to predict exactly what these stocks are going to do the next day. Here's the scary part. Market move 666. Dude, don't scare me. What the hell is this? The other day, you were talking about a Black Monday. The other day, now, you were also talking about World War III. And now these right here, Leonardo, I'm getting worried about you. What's going on here? Whoa, guys, not to worry. As always, no big deal, right? This market move sequence is not going to kill you. However, it will help you make a bunch of money if you learn how to use it, because this sequence has a high probability, like literally 80-90% probability of predicting what happens next. Let me try to break a chart for you and help you actually visualize what's going on. So the first question is this. I'm going to show you this chart, and I want you to try to really, focus and try to really be honest with yourself. What do you see? Okay, so what do you see when you look at this chart? And this is just a simple chart, guys. If you're trading, you could pull up your software in which you do your trades. Just pull up a basic chart. Actually, this is ES or S&P 500 futures. Focus. What do you see? As you can see, it's 3 days, right? So day 1, day 2, day 3. Where you see this, it's pretty much after hours before the market action. But what do you see in this chart? I'll give you a second. Maybe you see a pattern. Maybe you see something. Just think about it. And then I'm going to point out some of the things that I was trying to show you earlier in the very basic format of what a move 6 is and what a move 11 is, right? So let me show you this repetitive characteristic of these moves. This was on Monday, right? Do you see how initially things were popping higher, and then where does the main sell-off happens on the biggest volume? Do you see how this volume right here in the blue spikes up? Well, the markets were selling off when, remember, we're talking about a characteristic of a move 6. Move 6 sells off at the very end of the day, and generally the sell volume is going to be much higher than the buy volume. Okay, let's take a look right here. The next day, Tuesday, see the market tries to go higher and then it falls. Now, where does this fall happen? You see a spike in volume as well, and it's a sharp sell-off going into the last hour of the trading session. Right here, look at this. The market tries to go higher. Look at the biggest volume in the day. It happens right here when the market sells off. When? Within the last hour and a half of the trading session. So the main characteristic, and hopefully you were able to catch that, is the fact that they each start higher and then they sell off, confirming the very fact, the very characteristic of a market top move. The market is exhausted. It is having a hard time finding any traction in order to continue the move higher. Now let's break it down a little bit further. Can you possibly identify when this actually took place? Same chart, right? Now I'm actually going to show you that this is a move 6. Remember, it goes higher, then sells off. This was a move 11. Remember, we were talking about a topping formation. Kind of looks like a pyramid where the market opens up and closes about the same level. But in the meantime, it tried to go higher. You see 1, 2, 3, created a triple top intraday and returned on the sharp sell-off going into the close. And then rebounded slightly to close at about the same level. That's an 11. Now, there's different variations of 11, guys. If you really want to learn all the details, right? Actually, it is simple, but not quite as simple as I'm trying to show you right now. There's actually some other details to increase your probabilities, such as understanding the VIX environment along with the market moves. There is a ton of information on that in the course, so if you really try to learn this, I would strongly encourage you to click the links below and take the course. Focus right now, right here. Move 6, right? So the market goes higher, then sells off. So you got to sequence 6, 11, 6. The question is, number one, how often do you think this such sequence takes place? And when do you think the last time we actually had this sequence happen in real life markets? Which, oh boy, I think there's a part of the picture that actually shows you when this picture was taken. I think I just gave you the answer. So the picture was taken on the 4th, right? It was taken on October 4th. So the days right here are October 1st, October 2nd, and October 3rd. Move 6 on October 1st, move 11 on October 2nd, move 6 on October 3rd. What does that mean? Okay, and literally, okay, do you remember what takes place after this? Do you remember what takes place on October 1st, 2nd, and 3rd? I can tell you that there's a lot of guys that watching this that should remember this, especially the ones that were buying a ton of calls, because a lot of them were trying to contact me, trying to figure out why they're losing money. We figured out they were losing money because they kept buying the dip. And as you know, in a lot of my videos dating back to, May and some summer videos, I've been stating that buying the dip is not going to be a viable strategy anymore. You're going to be doing much better doing exactly the reverse of that, and that shorten the bounces. For those of you that don't remember what actually happened, let me show you on a broader scale what the sequence was actually leading up to that has helped a lot of our traders in the VIP chat room make a bunch of great trades. And this is how we're actually able to predict this. So here's a weekly chart on S&P 500. So this was October 1st for October 3rd daily chart. You see these 3 dots right here, 1, 2, 3. Do you see the corresponding candles? Do you see one black candle right there with a tail sticking out in the air? We'll call it a failed rocket launch, which is a bearish reversal type candle. The same formation of the candle right here, and the third one, a larger black candle, but the idea is the same. Every time on these 3 days, the stock tried to go higher, they failed, and they dropped to the lowest points of the day, or at least to the points where they have initially started trading. So they try to go higher. At the level, there were a lot more sellers rather than buyers, and therefore the stock had to surrender all the gains for the day. Now, they're very bearish type moves. So the moves that I'm showing you, specifically if we're focusing on move 6, these were the 2 black candles. They were the move 6. Move 6 right here. That one in between was move 11, and that was move 6 again. Now, the importance is to understand that this sequence does not happen very often, and when it does, it really does pay. It does pay you a lot of money to pay attention to it when it happens. So what happens after October 1st, 2nd, and 3rd? We're getting something that has not happened in a long time. What do I mean by that? I'm not just trying to say, look at the magnitude of this drop. That's wonderful. What I am saying is, the drops that have occurred before, right, they were buying the dips. And this is the first time they were not buying the dip. And so a lot of people, as you can see, got excited right here. You got this big white candle right here. Well, that was an exception, right, because the trend has changed. The idea here is this. This sequence 6-11-6 is actually pointed out. Not just a 1-day drop, not just a 2-day drop, not just a 3-day drop, but more like a 2-week drop in a row consecutively, with the exception of like a couple of days out of the entire 2 weeks. Okay, out of the entire month, literally. This is how you would have been able to utilize this. And let me just fast forward this just a tiny bit forward. Okay, again, this took place on October 1st, 2nd, and 3rd. It corresponds to these 3 candles. Then you get this consecutive drops. The consecutive drops are crucial, guys, when you're trading options, because as you know, option is a derivative of the stock and it deals with timing. So the most money you will be able to make on options that have very short-term expiration. Now, to no secret, you could be buying options that are a year out or 2 years out, but you're going to spend a lot of money buying these options because you're buying a lot of extra time for that move to take place. So that's why utilizing a formula to identify these higher probability opportunities could pay you so much money, because you're going to be able to predict specifically when this move is actually going to take place. Okay, so then the environment in November has changed, right? We started going sideways. So we had some days up, some days downs, and so on. So the market basically, and you can pull up, this is a chart of S&P 500, but you can pull up any other chart and you see, very well-defined resistance level, very well-defined support level. But clearly the market environment has changed. What can the sequence predict for the day trading and swing trading if you see it again? Well, if you see it again, I know a lot of guys that I talk to, they look at like a 4 or 5 day chart. So this is the same chart of that 6-11-6 move, but on a longer term scale. This is a 5 day. So as you can see, if you were witnessing this, remember I was drawing early in the video this move 6 like this. In other words, it goes higher, sells off towards the end of the day. So combination 6-6 tells you that the drop-off is near, that the stock market is about to drop. Okay, so keep this in mind because it's going to be crucial in our analysis of the current situation in just a second. This is how this sequence looked on a 5 day chart. Again, I want to point out how this sequence looked actually on a longer time frame, the daily chart. This is how it looked on the daily chart right here, pointed by these 3 dots. So try to keep this in mind because all of this stuff is very, very important. So I'm going to ask you a series of questions at this point to kind of illustrate a point. What is this? In other words, what does this look like? Okay, I'll tell you first what it is like as far as the time frame. This is actually a 1 day, 1 minute chart of, again, S&P 500 futures. What do you see? I kind of drew the characteristic of this move. As you can see, again, you have a defined sell-off going when between 2 p.m. and 4 p.m. So in the latter part of the day, you have a sell-off. What it really represents is a move 6. Now, this move 6 actually took place on December 11th, 2018. Next chart. What is this? Well, clearly you should know the answer by now that this is also a move 6. And the definite characteristic of that is the sell-off very end of the day. Do you see how this one just a really good example, right? See the spike in the volume and see how it sells off. Now the market's still positive for the day at this point, which is incredible, right? But it did surrender pretty much all the gains for the day. Okay, now this is actually a move 6 on December 12th. Okay, so if you pull up your software and try to plug S&P 500 futures, you should see on December 12th a chart that should resemble this right here, depending on what time frame you're going to look at. Again, this one is utilizing right here. It tells you 1 day, 1 minute chart. Okay, now third picture here, third portrait. What is this? Okay, seeing the sell-off again, very end of the day. You see right here, boom, spike in volume right before the close. So that's a move 6 on December 13th today. Okay, so what does this tell us if we put this together? Let's put the last 3 days together. Does this remind you of anything? Does this remind you of anything? Do you remember we were doing an exercise not so long ago when I was asking you, hey guys, try to zoom in and focus and try to tell me what you see? Well, it looks awfully similar to the picture I was showing earlier, with the exception this is not the same picture, okay? But I try to highlight the action. I try to highlight the characteristic of this market move, and hopefully now you get the idea that this is the same thing, okay, that took place on October 1st, 2nd, 3rd before the drop. Do you remember? Okay, so right here, move 6, and look where it leads to. It leads to a drop-off. Now these, you guys, we haven't talked about these, but these are identified as moves 3 when the market actually gaps down the next day. Here's what we got. Instead of the picture I was showing earlier, actually we're getting this, instead of October 1st, 2nd, 3rd move of 6-11-6, we're getting the move 6-6-6 on December 11th, 12th, and 13th. And this is how it would look on the chart. So here's the chart. Okay, again, similar idea. Please, I talk to a lot of traders that think a lot about the size of the candles. It's not the size of the candles that matters, right? What matters is the formation of the candle. And so I want to specifically point this out to you. So these are the last days of trading. So this is December 11th, December 12th, December 13th today. So look at these three candles. In my view, they're pretty much identical to these three candles right here, with the exception that this was 6-11-6 and this is 6-6-6. The similarities in the fact, again, it's in the candle formation. Do you see the scales? They're sticking up in the air. Especially this one is really nicely defined right here. This one in the middle, the black candle. It actually is telling you that the reversal is coming. You can also identify same formations on the candles right here and see what happens next. The market starts selling off. Same idea right here. Same idea right here. So anytime you see a candle with a tail that's sticking out in the air like this, this actually tells you that institutional investors are selling stocks. They're not buying. The main misconception is this: when a trader looks at the screen that day and he doesn't take into account all the market moves and the divergences that we specify in our divergency scores, what he's looking at is a green screen. In other words, on a day like this, the market actually looks quite bullish. And so the last thing generally a trader thinks about is buying put options. Generally, a trader will look and be like, oh man, everything is in the green. What, am I an idiot to buy puts today? Come on, man. Oh man, they were right. There is a Santa Claus rally that's going to be taking place. Hey, I'm all in on calls. And so what happens the next day? Well, not that pretty, right? So the market drops. The calls are depreciating at the speed of light. So, I mean, can you imagine being the guy that sees the screen in the green right here, followed by this sell-off right here, followed by this sell-off right here, followed by this sell-off? The point I'm trying to make, okay, is this 6-11-6 move. As you can see, they don't happen every day, so it's not like a sequence that you're going to be able to observe weekly, but when it does happen, it gives you a high probability of what the market will do next. So consider this observation as just one of the observations. There's actually a ton of other observations here in the chart. I don't want to get into all the details, right? Because otherwise it'll be like a 5-hour-long video. And so if you do want more details, click the links below and take the chart course, take the 13 Markets Move course. You'll be able to get all the details, okay? But the idea is this. Right here we had a situation of 6-11-6. Right now we have a situation of 6-6-6. I know it sounds bad, 6-6-6, right? But I mean, it really, guys, it's a coincidence, that it's a market move 6, and we got 3 market move 6 back to back to back. And what it really tells us, the move 6, is this is a top. And again, some of you may be like, well, what do you mean it's a top? We look like we're all the way here at the bottom. How could these be the top? Okay, well, this is just a miniature daily case scenario for what's already taken place right here. Do you see top 1, top 2, top 3? If you pull up the chart of Amazon, you're going to be able to see the same thing. If you pull up NASDAQ, you're going to be able to see the same thing, with the exception on NASDAQ. These tops are not precisely pretty much down to the point like here. NASDAQ tops, they actually at an angle, like downtrending at an angle, but you will clearly see 3 defined tops on NASDAQ as well. So this is a smaller representation of what's actually taking place in the near term, meaning like tomorrow, December 14th, we should see this, okay? And I'll give you a probability based on our scenario, okay? So in other words, there's an 80 to 90% probability of a near drop-off, like a potential case of 6-2, 6-11. Okay, there's actually a 75 probability of a gap down tomorrow on December 14th. And so chances are the market is going to open lower and it's going to continue lower for the rest of the day. Now, in the event of a consecutive sell-off, what you will get is a sequence like 6-3-3. And I've pointed this out to you before. I mean, this is exactly how this situation of 6-6-6 may unfold, okay, is in the example I was showing you, this 5-day chart back from October, right? So this was the 6-6, ended up in a 3-3 type sequence, okay? And I'm saying that what's going to happen on December 14th and following Monday could look like this, okay? Now, please observe that nothing gives you 100% probability, but considering that this sequence is so rare, 6-11-6, 6-6-6, they're rare, like they don't happen every month, and this is why I believe this is something worthy to be paying attention to, because that is not a sequence that someone should just neglect and forget about, because if you take advantage of it, you will be able to make a bunch of money. So with that being said, if you're wanting to learn more about the market move sequences and probabilities, then click the links below this video. Take 13 Markets Move course. If you have any questions about any courses, or if you have any questions about trading options, trading stocks, and if you want to talk just probability, if you want to play a game of chess with me or any one of our senior traders here, just schedule a 20-minute trading session. Get all your questions answered. Look, guys, New Year's just around the corner. You know, if this year has not been your best trading year ever, you know, it's probably a good indication that it's time to switch up your strategy a little bit. It's probably an indication that you need a little bit more ammunition. And, you know, I have traders reach out to me daily, and sometimes it's not that the trader is a bad trader. Like, I talk to a lot of guys that are capable of catching a good trade, but sometimes it's a matter of identifying some better opportunities. A lot of times I talk to guys that are just often trade the same stocks, like 2 or 3 stocks, and their watch list is like 10 stocks. And so there's definite limitations to doing this because you're really costing yourself a lot of opportunities that are out there in the market. Literally in economics, it's like an opportunity cost. If you consistently trade the same thing, then you're going to be missing out on some of the other things. So our watch list is about 300 stocks that were observed daily. Recently would take a trade on one of the stocks on the watch list was XPO. That trade produced over 800%. But I mean, we've been watching that thing for, you know, last couple of weeks to just be able to catch that trade. Guys, if you're in a mission to change your results, look, just changing a few small things. For example, changing your strategy on how you enter the trades, changing the strategy on how you exit the trades. A simple strategy could help your account grow substantially higher. So if you don't have a strategy in place right now, want a better result next year from what you've had this year, definitely take the 13 Markets Move course. Okay, get your questions answered in this 20-minute trading session. Guys, take action now. Make your next year your best trading year ever. I'll catch you guys in the next video.